tax loophole helps Bitcoin holders? This seldom utilized tax loophole helps Bitcoin holders save big. That implies a crypto owner may choose their most costly Bitcoin and use that to calculate their tax liability. A greater cost basis means less tax since capital gains are calculated as sales price minus cost basis. Bitcoin is down approximately 36% from its all-time high in November, yet a tax loophole allows crypto investors hide their earnings from the IRS. The IRS recognizes cryptocurrencies as property, therefore spending, exchanging, or selling them is taxed. There is always a discrepancy between the cost basis and the market value when you spend Bitcoin. It may trigger capital gains tax. Taxes may be reduced by using a little-known accounting practice called HIFO, highest in, first out. When selling crypto, you may select which unit to sell. That implies a crypto owner may choose their most costly Bitcoin and use that to calculate their tax liability. A larger cost base means less sales tax. The user must maintain track, hence meticulous record keeping is required. Calculations to the IRS cannot be verified without precise transaction and cost basis information. Keeping solid records or employing crypto software is required, says Shehan Chandrasekhara, CPA and Director of Tax Strategy at Cointracker.io, a tax software startup. It's true that many people now utilize such software, which makes accounting quite simple. No one knows it exists. The key to HIFO accounting is keeping track of every crypto transaction you make, including when you buy, how much you pay, and when you sell. If you don't have all transactions recorded or aren't utilizing the correct software, FIFO, first in, first out, takes over. When you sell your tokens, you must sell the earliest bought coin. With a low cost basis, you may face a higher capital gains tax payment in 2021. Crypto holders get tax-free passports also, the wash sale rule. Experts told CNBC that combining HIFO accounting with a wash sale regulation might save taxpayers even more. According to OnRamp Invest CEO Tyrone Ross, losses on crypto assets are regarded differently from losses on equities and mutual funds since the IRS considers them property. Because wash sale restrictions do not applicable, you may sell Bitcoin and immediately purchase it again, but you would have to wait 30 days to do so with a stock. This tax loophole allows investors to sell Bitcoin at a loss and acquire it again at a cheaper price. Losses may be used to reduce taxes or offset future profits. So, a taxpayer bought Bitcoin for $10,000 and sold it for $50,000. This person would owe $40,000 in capital gains. This same individual might reduce their tax liability by harvesting $40,000 in losses from past Bitcoin trades. You want to seem poor, Chandrasekhara said. Depending on their intelligence, Chandrasekhara says he sees this regularly to quarterly. Buying back the cryptos quickly is also important. Buying the drop allows investors to catch the recovery if the digital coin's price rises. Don't just buy Bitcoin, earn it. When you spend with BlockFi, you can earn up to 3.5% back.